SC. He is an accounting lecturer from Universitas Muhammadiyah Yogyakarta. For Mr. Hafiz, time is yours.
All right, thank you very much, Nabila. Hello, good afternoon, everyone. Assalamualaikum warahmatullahi wabarakatuh. Alhamdulillahi rabbil alamin. Wassalatu wassalamu ala asyrafil anbiya'i wal mursalin nabiyina wa maulana Muhammad wa ala alihi wa sahbihi ajma'in. Amma ba', our grateful hope should be delivered every time to Allah subhanahu wa ta'ala, and salawat and salam just sent to our Prophet Muhammad sallallahu alaihi wasallam. First of all, I would like to thank you very much to Ms. Fitri that give me a chance to be a moderator in these sessions, because I have opportunity to meet with a special speaker today, Mr. Jazib Ali. Hello, Mr. Jazib. I think this is the first time we met virtually.
Yes, this is the first time we have met, but I was in Indonesia in Yumi a few months back. So I spent about 1 month over there, and yeah, it was a great place. I made many friends, and I met quite a lot of guys, not just in the university, but outside as well. So overall, my experience of Indonesia and UMY was really nice. So that is the reason that I agreed to try and share my knowledge that I have with all of the students over here.
Okay, all right. How did you feel about Yogyakarta, Mr. Jazib?
Really nice. Like it was a good adventure. It was a good adventure. At the same time, we learned a lot. We were sent by our university about 20 students in different batches. Some went to Indonesia, some went to India. I was the lucky to come to Indonesia. So I learned a lot, made many friends and many colleagues. So overall, it was a very nice experience.
Alhamdulillah.
And I would like to say thank you very much for hosting us as well.
Oh, yeah, you're welcome.
It was a great trip.
Okay, hopefully you can visit again Yogyakarta.
I would love to, but only if you want me in person lectures. I would like to, yeah.
All right, thank you very much, Mr. Jazib. Okay, ladies and gentlemen, before we start our discussion and general lecture, please give me a few times to introduce our speaker today. So I will share my screen now. All right, can you see my screen already? Okay, so our topic today is about capital investment. So this is very important, especially for accounting student, because after you graduate from this university, usually you will be working in the companies, and most activities conducted by the accountant must be related to the financial aspect. So the capital investment is one of the prominent aspects that will be should be comprehended by the student. Okay, actually, Mr. Jazib, I'm not a financial accounting scholar. My major is in public sector accounting. So when the Miss Fitri offer the occasion to be moderator, I'm very interested, because I also want to learn from you, because you have got many experience in the companies in terms of the financial issue. Yeah. So our speaker this afternoon is very special. Mr. Jazib Ali graduated from the Institute of Business Management from Pakistan, and then he continued to pursue his master twice, yeah, Mr. in Pakistan and Institute of Business Management, and then again maybe Mr. Jazib didn't satisfy with master degree in our country, so he continued the master program again in University of Bradford in England, and he also has experience in the financial companies, namely Moody Analytic in the United States, in the credit scale assessment, and also in the reputable financial institution, namely Standard Chartered Bank, England, and also Corporate Financial Finance Institute in Canada. I think this is for the license and certification. Yeah. For the experience, he was employee in the Standard Chartered Bank Pakistan and also Bank of China Pakistan operation. So to make this time is efficient, you can start your general lecture, Mr. Jazib. Maybe the time is around 1 hour and a half, and after that we will have the discussion Q&A. For the time is
do I have the screen sharing rights?
The admin, please give please assign Mr. Jazib account to can get share the screen.
Can you guys see my screen now?
Yes, Mister. We can
Okay.
see. You can start now. Okay, time is yours.
Thank you very much. As already discussed by my brother Hafiz Sofiani about myself, I started with my bachelor's in Pakistan. I did my bachelor's in business administration. Then I continued with my MBA as well. After that, I worked in the banking sector in Pakistan for about 6 years. And then, a human being naturally is not satisfied with whatever achievements or whatever experiences they have. So as a kid, when I was just 10, 11-year-old, I always dreamt to one day go to UK and pursue a good qualification. This was the reason that even after I was at the peak of my career in Pakistan in Standard Chartered Bank, I sacrificed that career. I moved to England to pursue higher degree. So I completed my MSc, and just within this month in December, I was graduated. About 2 weeks ago, we had this ceremony as well, graduation ceremony. And right now, sorry.
Congratulations.
Thank you very much. So I have completed my degree, and right now I'm working in a healthcare agency in the finance and accounting role. Alhamdulillah, they are going to sponsor me as well, which means that I would be in the UK for 5 more years. So hopefully all things go in the right place. But apart from that, it was a great opportunity for me to share my knowledge and my experience with you guys. Like I told earlier, that I was in Indonesia in UMY in September, October, and I had very good discussion sessions with the iGov department and Miss Olia, Professor Eko, and Professor Nurmandi. So it was a really nice session. I was there for about 1 month. So yes, overall very good experience, which is the reason that I agreed to share my knowledge and experience with you guys. And of course, this is my financial management is my strong suit. So whatever I have done, whatever I have learned is in the financial management sector. So if you guys can learn from that, it will be the biggest honor for me. So without further delay, I would like to start my session if you guys are ready.
Yes, we are ready, Mister.
Yeah.
You can proceed.
Yeah. So financial management. First of all, what is financial management? Financial management is a part of everyone's life. It does not have to be a company or a corporation. It's even applies in the life of a common human being, just like you and me. Whatever we decide, whatever work we do, we get some money out of it. We make some earnings, our livelihood, and then we need to have we have some expenses as well. Like we have to pay our tuition fee or our school fee or accommodation or traveling or food or anything like that. So whenever you are earning anything and you have to make some expenses, the first thing that you do is you plan. You think in your mind that, okay, I would be getting this much money and I have to pay my bills, my traveling, my accommodation, my rent. So how am I going to do that? So you plan, you calculate your earnings, you subtract your saving, your deduct expenses, and then you try and make some savings for the bright future that you want to have for a happy retired life. But after that, once you have planned, it's important to organize as well according to your plan. Do what you have actually thought, and do not detract from the plan that you already have. After that, it's about directing and controlling the financial activities. So controlling means that actually you have a control on your life, It happens in the human being life as well. It happens in the corporation as well. Over here we are doing we will be discussing about the corporate life, the company's expenses. So if they are making any sales, they are generating any profit, and if they have good profit, then what they do is they try and expand their operations. They may be able to expand their company in a different country. They may be able to launch a new product. They may be able to buy a whole competition out of the market. So it depends on which scale, which size the company is, and what is their future strategy is. So controlling the financial activities such as procurement and utilization of funds. So procurement and utilization of fund means that in this world, no company, no country, no person is self-sufficient. You always need some kind of asset, some kind of knowledge, some kind of money, some kind of means to achieve your goals. Like maybe if Indonesia has produces a lot of rice, then Indonesia can export rice. Pakistan is good with textile, so we export textile products. Japan is good with Japan and Germany are good with manufacturing cars, so they manufacture cars and export in the market. UK is good with financial services, so we export our financial services as well. So try and controlling the financial activities, and then procurement utilization of funds, which means that uh, in money matters. If you are going to if you are going to plan a new product, new project, or maybe expand your company, you would be needing the financial resources, which is capital. So capital can be through equity portion, yeah, your own money, or you can borrow that money from the financial sector such as banks or financial institutions. So how do you utilize and procure those funds? We will be going to discuss that. So capital investment. Capital investment may also refer to a firm's acquisition of capital assets or fixed assets. It is important to understand that what are fixed assets. Fixed assets can be your manufacturing plants, your machinery, your land, your capital, anything like that. So maybe that if a company is a textile producing company, then they need to have those textile machineries, which they can maybe import from a country, China, Japan, any country else, Germany, and then implement those plants and machineries, finalize everything in their location where they have to install the factory and machinery, and then start their operations. So it is important to understand that if you are buying or importing fixed asset, it becomes your capital investment. It's not like any other normal investment, like you do maybe buying your inventory or buying some short-term assets. It's different. It's difficult to do the accounting procedures as well, and it's completely different because this is a now strategic position, strategic investment. Maybe for next 10 years you are doing whatever you are doing now in terms of capital investment is going to change the next 10 years of your life. It can be, if you make good decisions, it can turn your life into a heaven, and if you don't make good decisions, then you will be in a tough spot. And the capital investment is also productive over many years, because when you install a machinery, you generate the profits out of it, you make the products for the next maybe 5 years or 10 years. So this is going to be a long term exercise. Regarding the financial aspect of this, if you are going to do the capital investment, if you're going to implement these plans, then you need a lot of money, because capital investment, fixed assets are really expensive. It's not like the normal budgeting procedure that we do, and we can fund that from our internal cash flows or from our profits. For capital investment, you always need an extra helping hand. An extra helping hand uh, can be your banker. Maybe they can lend you some money. Maybe it's a venture capital, or it can an angel investor as well, depending upon which cycle of the business you are in. If you are just a new company, bankers will not be supporting you, because they do not have any financial track record of your company, because you are just a new company. You have not made any sales yet, you have not earned any profit, you are not in the business for a long period of time. So at that point in time, if you are a new company, then the venture capital or an angel investor can support you. What are venture capital and what are angel investor? Angel investor may be like a rich guy who believes in you, who really likes your product, and who has the understanding of business, and he sees that yes, this is going to be a good project, so he invests in your money, he invests in your project. Venture capital are organizations, they invest in your business when you are in a early stage, but at the same time they take equity as well. So and venture capital also have their members of the company, the board, sitting on in your organization, in your board, understanding the things that you are going to do and supporting yourself as well. So this is a different. But if you are already in business for maybe 10 years or 15 years, and you are going, you have a good financial track record of making profits, sales and everything, then bankers are happy to lend you money. Bankers just lend you money. They do not come and sit in your office. They do not review your progress every now and then. But yes, they may request you to share your financial statements, financial books, and your financial track record, maybe quarterly, maybe half annually, or sometimes annually as well if you are a non-listed company. Okay, so next thing is the steps involved in the capital investment procedure. So first of all, what we do is we identify and evaluate potential opportunities. An example would be that when I was in Pakistan, there was a client who basically used to manufacture cars, like the vehicles, but they saw a potential opportunity of a big giant mobile company, mobile manufacturer, that mobile manufacturer was thinking to install their company or expand their operations in Pakistan. So even that the client, my client, which was a car manufacturer, uh, tried and contacted that big giant mobile manufacturer, and they had the deal, and then they installed that mobile manufacturing assembly operations in Pakistan. So now this company, who was actually manufacturing cars, now have a different product line as well, manufacturing mobile phones. So manufacturing mobile phones, they do not have the capability, they do not have the experience in it. So naturally the big giant company, I would not be quoting any names, they send their professionals in helping them out, understanding the procedures and everything. So this is the thing, that we need to identify and evaluate potential opportunities. The client was also in talks with another car manufacturing company to buy their project, buy their operations and everything. That did not materialize. But it tells you that sometimes in capital investment, sometimes what you do is you try and expand your core operations, like that car manufacturing company tried to buy the competition from the market. It did not work out, but then they saw that, okay, if this does not work, then why not we introduce a new product line, such as mobile manufacturing as well, and in which they did not have the experience, but they have the financial means. So if all they needed was to get that experience of manufacturing mobile phones, assembling mobile phones, which they got from the big mobile giant, the big company, and they installed the manufacturing plant and everything of mobile manufacturing in Pakistan. And alhamdulillah, they are still doing very good. I am still in touch with them. I have friends in the banking department that I used to work, and they are really progressing. So it's not like if you are doing one business, then you will be stuck with it. No, if you see that there are potential opportunities of expanding your business, maybe in a new country, in a new continent, you can do that. If you want to expand a new product line, introduce a new product line, like I said, cars and mobiles are different things, so you can do that as well. What you can also do is buy your competition from the market, because now you are one big giant, and the market share that company, that competition was attracting from the market, now belongs to you as well. So first of all, first stage is identifying the potential opportunities. Now next thing is to identify uh, what will be the operation and implementation cost of this whole procedure, this whole operation that you are going to conduct, like how much money you need, and how much money you need, as well as in how much installments and how much time you have to pay these expenses, pay these costs. So once you do that, you make a financial budgeting plan, and you understand that, okay, I have to spend maybe $1 million in the project, or £1 million in the project. And you need to understand that how long the cycle will be, like 3 years, 5 years, or maybe 10 years, or maybe just 1 year if it's a really urgent thing, if it does not have much time horizon. So you do that. But after that, you also do the cash flow analysis as well, that okay, if I have invested $1 million in this project, how much am I going to get in return from the project? How many sales are we going to make? What will be the number of product that I'm selling? What is the right pricing of the project, so that pricing of the product, so that I can enhance my sales, and uh, what is the optimum level of earnings. So when you do that, you come to an understanding of the total cash flows that you are getting, and over a period of time, maybe 5 years, 10 years. Once you do that, then you understand that okay, if the project is looks good or not. This is called risk assessment. You understand the risk that comes to you. If the project is if the product is, let's say, food manufacturing, so you need to have the licenses as well. Like, you need to have it approved from the different food manufacturing organizations or different departments. And if you're going to have a chemical manufacturing plant, then you need to have it approved from the EPA, which is Environmental Protection Agency. So it depends. Every business, every product that you are manufacturing has different regulators. Maybe for chemical sectors, it's the EPA, Environmental Protection Agency, which tells you that okay, the environment will not be harmed even if you are manufacturing or using chemicals in your plant. So it depends. Every business has different regulators. So when you approve it, you do the risk assessment and you get these things in place. Then now is the stage to implement your project. What is capital budgeting? Like I already told, that you need to decide on the project, and once you have decided, then you need to do the capital budgeting process, which is the ultimate ultimate process of determining the viability, if the long term investment that you are making on purchase or a replacement of a property, plant, or maybe a new product line or anything, are actually viable for you. By viable, I means that whether you will be able to earn more return than actually you are more money than actually you are spending on it. And since this is going to be a long term exercise, 10 years, 11 years, so you need to spread out your cost, you need to spread out your earnings, and then understand that how much the return you have. Because if you are talking about long term, then time value of money comes. So I'm not sure about the audience. I believe that it is an undergraduate audience and you should have studied time value of money. But in a simple sentence, I would say that if I give you 100,000 Indonesian rupiah right now, and if I tell you that I would give you 100,000 Indonesian rupiah after 1 week, which one will you choose? 100,000 Indonesian rupiah now, or 100,000 Indonesian rupiah next week? Which one will you choose?
Just now.
What is the reason for now?
Yeah, because of the time value of money, isn't it?
Yeah, because in the next week, maybe the inflation can hit, product prices can go up. So what things that you can buy in 100,000 Indonesian rupiah right now, you might not be able to buy those things after 1 week. So this comes as this tells you about the present value of money. So when we are expecting that okay, we will be having the expenses in the next 10 years for this project, but at the same time we will be earning money in the next 10 years from this project, then those cash flows, both outflows and inflows, we need to determine them on present value of money. So there is time value of money, which we have different formulas for that, which we will be discussing if we get some time today. But capital budgeting process, again, generation of idea, different ideas. Every department shares their ideas. There are multiple ideas, multiple alternatives. Some alternatives may go together, hand in hand. Maybe one idea can complement the other. Some ideas are totally different, mutually exclusive, so we cannot have one idea. If we are going with one idea, then we cannot go with different idea, but some ideas can work together hand in hand as well. So it depends on the project ideas that we have. After after that analysis of proposal, which proposal is going to be the key in making the company a big hit and making good profits for our organization. Then the accounting department does the corporate budgeting process, and then we have different departments who will be monitoring and auditing the process as well. So in capital budgeting techniques, like I told you that we will be carrying out an analysis of our cash flows, outflows and inflows, because this is what we base our decision on. If we are not making any profits, then of course the project is not going to be viable. We will be making losses. So naturally it does not make sense to go ahead. So capital budgeting techniques tell you in how much time you will be getting your investment back, or how much money will you be making out of the project, what is our internal return in terms of percentage, and if the project has a good profitability index or not. So like time value of money, the example I've already shared, it is the idea that money available at the present time is worth more than the same amount in future due to its potential earning capacity. So 100,000 rupiah right now may buy you a lot more things than maybe 100,000 rupiah next week, because of the inflation, prices going up, maybe a shortage of products. So right now, maybe I maybe say that if you go to a shop and you have to buy bread, right, and the shopkeeper has only one bread. So if I go to the shop and Hafiz Sofiani goes to the shop to buy bread, right, and there is only one bread, the shopkeeper will give the bread to whom, me or Hafiz Saab? Hafiz Saab, what do you think? Can you hear me?
Yeah, I'm sorry, my signal is quite bad.
Yeah. So I was saying that if we go to, you and me, if we go to buy bread from a shop and the shopkeeper has only one bread, so who the shopkeeper will give the bread to, you or me?
Oh,
He will give the bread to whoever gives him the most money. So this is the time value of money. Potential value of money right now is always higher than the potential value of money in the future, because of the inflation, prices going up, shortage of products, different issues like that. Okay. Yeah, time value of money is also referred to as present discounted value. Whatever earnings we are going to make in the future, we have to discount them. We have to see and reduce the impact, and now check that what value the future the money has right now. So time value of money has different formulas. A simplest formula is future value is equals to present value multiplied by 1 plus I over n. Now I is the interest rate that is normally in the country. It's the uh, progress rate, inflation rate in the country, and n is the number of periods, compounding periods in a year. So n can be, if you're talking about yearly basis, then it's just one, because 1 year is, you will consider 1 year. But if you're talking about quarterly, then there will be 4 periods in a year. If you are talking about semi-annual, then there are 2 periods in a year. But if you're talking about monthly, then there are 12 months in a year. So the n will be considered as 12. And number of years is, again, like I told you, that if you're going to implement a project for over 5 years or over 10 years, then accordingly you put the number of years in the formula. So T is the number of years you are working on, you're working the project on. Complex investment decisions. Company is having money, company decides where to invest this money. For example, new machinery project in market, we have already discussed this. But the thing is, on what basis do we take a decision on time, like which project will be able to complete and start generating money quickly, or should we talk about the rate of return, how much interest, how much percentage return we will be getting, or should we base our decision on the total investment in terms of absolute money, like maybe dollars or Indonesian rupiah or pound sterling, how much return will we be getting? So this is there are different variables we can base our decision on. Warren Buffett, who is a great investor in the financial industry, he says that investment decision should be made on the basis of most probable compounding of after tax net worth with minimum risk, right? So after tax net worth, it means that we should be basing our decisions on the amount of money that we will be getting, and with minimum risk as well. So try and reduce our decision to as much as possible. It is important to understand over here that risk cannot be completely mitigated. Risk cannot be eliminated, but yes, you can try and reduce your risk. You cannot completely eliminate risk. Okay, so practical study of techniques. There are different methods which we saw in the previous slide. It's payback period, discounting payback period, net present value. This is time value of money. Net present value is time value of money. We use it. We use the formulas to come to NPV. Accounting rate of return, internal rate of return, and profitability index. So now studying these techniques one by one. Payback period is the length of time required to recover the cost of an investment. So in the previous slide, if we see that on what basis, so it says time or rate of return, or maybe like Warren Buffett said, that after tax net worth, which means that the absolute money amount that we will be discussing. So payback period is, it gives you a formula to understand the time length required to get your investment back. So payback method, which is calculated by counting the number of years it takes to recover the cash invested. So let's say if you have invested 1 billion Indonesian rupiah or $1 million right now, and you see that, okay, I will be getting $10,000 today, this year, $15,000 next year, $25,000 the third year, something like that. So you will be able to identify, you will be able to calculate the whole future cash inflows, sum them up, and then it's divided by the total investment required right now, the investment that will be going out today, which means cash outflow. So cash outflow divided by total cash inflow, you will be able to get the total payback period. In how much time, how much years, maybe months. A month is not, of course, not possible, but in many cases it will be around 3 years, 5 years, when you will be getting your money back if you are going to invest in a very big project. But let's say that if you want to invest in a little maybe a laptop, and you see that, okay, I will be investing in my laptop or in my professional camera, and then I would be giving the professional camera services to weddings, photo shoot, something like that. So you see that, okay, my professional camera is maybe $1,000, and I will be able to generate 500 from one photo shoot, second photo shoot 500 again. So all it takes for you to is get 2 professional photo shoots, and you will be able to get your $1,000 back. So you divide the total outflow money right now, which is $1,000, and divided with the total cash inflows. So you understand that, okay, how much time will I have to get my money back? Now, net present value is the difference between present value of cash inflows and the present value of cash outflows. NPV is used to in capital budgeting to analyze the profitability of a projected investment or project. So now, total value of cash inflow, I have already discussed that in a big project, when you start making sales, you start making profit, what you do is you discount the project, you discount the cash inflows which you may be earning in year 5, year 6, year 10. You discount those earnings to today. Like what is the impact of that cash inflow in today's time? So you use the formula of time value of money, which I showed you earlier, and then you subtract the initial cash inflow from that you have already invested from that amount. Like in the previous example that we gave, and the professional camera will be about like I said, that you will be earning $500 in one photo shoot, $500 in the second photo shoot. So what you do is you divide those, you discount those inflows in present value of time. So if you are earning $500 from a photo shoot, maybe 6 months after, it does not have the same value today. Maybe it reduces in value from 500 to 450, right? And the second photo shoot you get after 1 year, so it further reduces the money. So if we're talking about maybe $350, so overall you earned about $800, but your total investment was $1,000. So it means that you are making a loss of $200 right now. But if you are able to get, so which means this is not a good project. But having said that, just consider if you get a third photo shoot as well, and you get another 500 from that, and you make, uh, when we discount the value comes to about 250 or 300 after discounting, using the formula which I have showed you in the previous slide. We can discuss this formula I'm talking about. So when we discount that, the overall value of that third photo shoot comes out to 300. So like I told that the first photo shoot we will be getting 450 in the present value, even though we were getting 500, but we discounted, and the discounted value I'm just assuming over here comes out to 450 using this formula. And then the second value comes out to 350, the third value comes out to 300. So it means that overall you earned about 1100, and your total investment on the professional camera was just 1000. So it means that you made $100 in addition. So it means that, okay, this project or this buying decision or capital decision was a good one. So you made profit from this camera. And this is just a little example in our human life. But if we are talking about corporates, then they have a lot of sales coming in. They invest their money in different product lines, invest their money in different countries to try and expand their operation. So it overall, generally, it complicates the whole project, the whole process. But at the same time, the gist of the method of the accounting procedure remains the same. So if you understand the basics, it does not matter if you work in a small firm or in a big firm, you will always be working the same thing. And the baseline, the basic concept remains the same. Okay. Accounting rate of return, it is basically the percentage measuring the average annual operating profit against the average investment. So like I said, that average annual profit. So it means that the project that you have invested in, you make some sales, you make some expenses as well, and at the same time you pay some salaries, your capital expenditure, depreciation, you pay taxes as well. If you have borrowed money, then you pay the interest cost as well. You pay dividends to your shareholders as well. Finally, whatever profit you have, you divide it by the total investment as well. By the way, dividends are always paid after profit, so you do not include them in the calculation, but you subtract all the expenses, including tax, including your interest rate expenses, and the final bottom line figure, the annual profit, you divide it with the total investment, and then you multiply it with 100. So it tells you about the rate of return, accounting rate of return. If it's positive or if it's low, then it tells you that it's not if it's low, then it tells you that it's not a good investment. But if it's a higher accounting rate of return, meeting your overall goals, then yes, you can go ahead with the process. So it depends, sometimes it depends with your internal rate of internal thinking as well, internal goals as well, that how much return are you going to get from this project to make this investment. So sometimes it depends on your internal thinking as well. Give me a minute, please. Okay. Profitability index. It is another appraisal technique calculating by dividing the present value of future cash flows of a project by the initial investment required for the project. Now, what we do is we divide the present value of future cash flows, the cash flows that we were getting in maybe 5 years, 6 years, 10 years. We discount those earnings and divide it with the total investment required. Now, my question to you is, what is the difference between profitability index, which has the formula PI is equals to present value of future cash flows divided by initial investment required? What is the difference between PI and what is the difference between payback period? Payback period is investment required divided by net annual cash inflow. The formula is different. The formula is upside down, but at the same time, in payback period, we do not take into account the the present value of inflows. But in profitability index, you see that the first thing in numerator, it's present value of future cash flows, which means that whatever cash flows we were getting, we have to discount those in today's value, divide them with the interest rate, that is going on in the market, subject them to the interest rate which are going on in the market, and then the number of years as well, and then we divide it with the initial investment required. So the formula is different, but and also we have to take into account time value of money as well in case of profitability index. So it tells you about the profitability value. It can be a number, particularly it will be a number which will tell you if the profitability index is good, is viable or not. uh, Internal rate of return. There is always a debate between NPV, net present value of money, and net present value of future cash flows, and internal rate of return. There is always a debate that which one is the good one, IRR or NPV. So although it's complicated, it depends upon the management of the company. That sometimes the management chooses NPV, sometimes the management chooses IRR, but these are the two most important methods of basing our capital investment decisions on. So IRR is the interest rate at which the net present value of all cash inflows, both positive and negative, from a project or investment equals zero. So it tells you about the break even time. It tells you when your whole investment is returned to you, and it tells you about the interest rate as well. So it's a combination of 2-3 things. It tells you the interest rate return that you are working on. So the company might be saying that, okay, we are investing so much money on this project, we should get at least 20% return. So they have already based their decision on. It also tells you about the future cash inflows and outflows of the money, and so that how much money they are going to invest, how much money they're going to get, and if the project is desirable or not. So internal rate of return is a combination of 2-3 factors. And like I already mentioned, that there is a debate between which one is the good one, IRR or NPV, and it depends on the company management, the accountants, the managers to choose the better one. But generally it always comes out to the absolute money. So NPV has the higher value, but IRR is also the second most important factor. And IRR is basically it has a certain formula, but it's more about the calculation and trial and basis to understand that, okay, if we are going to get this much return, then how much will we make? If we are going to make this much return, then how much we are going to make? But the idea is that at any interest rate, where the present value of all cash flows and the future value of all cash flows comes out to zero. Zero means break even, whereby you are not making any profit or any loss. It only tells you the rate of return, so that at least at this rate of return, our investments are the total value of our project comes out to break even zero. We are not talking about profit here. Then we choose this internal rate of return. It gives you an idea, and once you have been given the interest rate idea, then you base your calculations on the higher one, so that you start making profit. The formula might seem a bit different, a bit complicated, but at the same time, it's just the positive addition and subtraction of all the future cash flows, making sure that the total sums comes out to zero. Okay. Risk analysis and capital budgeting. This would be the last slide of this lecture. But there are different techniques to analyze the risk involved in capital budgeting. The techniques can be standalone, and the techniques are different in terms of there are the techniques which can go hand in hand together, but there are techniques which have to be standalone as well. By standalone, I mean that you will only be proceeding with one particular risk analysis technique. Risk analysis techniques can be sensitivity analysis. In sensitivity analysis, we try and increase or decrease the value of different variables. Variables can be your interest rate, variables can be your number of sales, variable can be the price that you are thinking, variable can be the interest rate from the bank, variable can be the inflation rate, so anything like that. So if you try and increase the interest rate in the market set by the government, so now you see that, okay, I was paying 8% interest rate, now I will be paying 10% interest rate. So it means that your interest cost to the banker from whom you borrowed the money will go up, so your profits go down. At the same time, if inflation goes up, then it means that the prices of your product will go up. If the prices of the product go up, then you make more money, so profit goes up. And break even analysis, like I already told, it's a kind of internal rate of return, the point at which your future inflows and outflows, future outflows future inflows and the current outflows become zero. So it tells you at the number of interest rate return, as well as the number of units that you need to sell, number of units of the project of the product you need to sell to come out on a break even analysis to make zero profit. We are not talking about any further profits. We are just understanding that, okay, at what interest rate or at what price or at what unit our total income would become equal to whatever we are investing right now. So the total return is zero. So there are different kind of returns, and there are different kind of risk analysis technique. And when you come out to break even analysis about zero profit, zero loss, then you try and base your calculation a little higher, increase the product price a little higher, aim for the uh, units being sold a little higher, so that you start making profit. And decision tree analysis, it involves a lot of other procedures as well, and different techniques overall in the capital budgeting process. So that's it for now. If you have any questions, please feel free to discuss.
All right, thank you very much, Mr. Jazib, for your sharing. I think I was getting this material about 10 years ago, yeah, in my degree. So I would like to thank you very much to you for refreshment for me regarding this material. All right, I
Right.
think this material is very interesting, and of course, this is very important for all students to understand about that, because you need to prepare yourself before entering you in the work, yeah, in the company. Because after graduate, of course, you will looking for the job. So accountant students usually they are working in the financial analysis, especially from UMY. Many of alumni from this department are working in the financial analysis. Okay, thank you very much, Mr. Jazib. Maybe any questions from the floor? For 3 questions, perhaps, for the first session of Q&A.
Please raise your hand or type in the chat if you have any questions.
Yeah, you can typing your question in the chat if you are shy, because Indonesian students and Malaysian students have the same characteristic, Mr. Jazib. Yeah, sometimes they shy to ask questions, but after the class, they, they give the question and outside of class.
I will tell you a funny story. I know I have been to Indonesia. I have given some lectures over there as well in UMY. So I used to say one thing when I used to start my class, that whoever does not ask a question or whoever does not interact in the class will not be going home. Unfortunately, I cannot do this here because it's a virtual class. They are already home, so I can't do that. But yeah, I used to do that all the time. Before starting a lecture, I used to say, if you do not ask a question or if you do not interact, then you are not going home. So,
but we cannot apply the similar regulation now.
If you have any question, you can just type in the chat, or you can come and speak on the video or audio as well, and it's fine. Don't worry about it. As long as you are learning, it's all good.
Yeah. Maybe I will start the question, Mr. Jazib, because when I was in my degree, I think this subject is one of the difficult subjects. And at the time, I was thinking maybe there is any special software that can help us to calculate the analysis. Is there in the reality?
Are you talking about formula, or what are you talking about?
Yeah, talking about the formula. For example, if you are as the practitioner want to analyze, is there any software that can help you to do that?
Now everything is available in the software. Yes, even Microsoft Excel, they can help you. They have different formulas. But yes, there are different softwares used by the accountants. I was a banker, so I do not have an experience of the softwares. But yes, if you want to uh, do these formulas, that even in Microsoft Excel you have different formulas such as NPV, future cash flows. So all you need to understand is the commands that you would be entering in Microsoft Excel, including the values, and you can get the formula. You can get the returns.
All right. Okay, guys. It's a good news from Mr. Jazib. So you don't worry, yeah, to work in the financial institutions.
No, financial. Yeah, this is my overall experience has been in the financial sector, in the banking sector. So I was, of course, working in those areas, but every accountant, every financial professional, or maybe every individual in the financial sector has different experiences. So my experience is from the banking side, from understanding how are we going to lend to the customer. But if you're working in a company, then you will be on the other side of the table, and you will be making your calculations on internal return and external returns, and how much money you will be getting. It varies with the varies with the experience or the profession you are in.
Okay, all right. Okay, guys, maybe any questions? I have started the questions to stimulate. And if you shy to speak in the video conference, you can type your question in the chat.
Maybe they can raise their hand and ask questions if they have anything in mind. If anything is bothering you, please don't feel shy. It's okay. We are all friends here.
Yeah. Okay, in the chat, and no hands is up.
I think they are shy. It's okay. If you have any question, you can maybe forward it to Hafiz Saab, Hafiz Sofiani Saab, and sir, maybe you can forward those to me.
Yeah. All right. Okay, Mr. Jazib. Actually, I'm curious about your research thesis. Do you conduct thesis when you pursuing your master?
Yes, we had a dissertation. It's thesis, like you said, dissertation or thesis, different names, but same thing. We did have a dissertation. I worked on the impact of COVID in Pakistan, and then what were the policies of Pakistan government and banking sector to combat this COVID and try and progress our economy. So yes, overall experience was that. At that time when COVID was happening, I was in Pakistan. I was working in a bank. So whatever policies set by the Pakistan government and the banking sector, I was right at the center of implementation of those policies. And overall, after 2 years, when this COVID thing slided down, it was discovered that Pakistan was one of the top performing countries, top 3 countries. Pakistan was really praised by the international organization such as United Nations, World Health Organization, and others. in making good policy decisions to combat the COVID. So I was naturally curious of what exactly were the policies and what was the impact to study them, because although I was implementing those policies, I did not have much understanding of why these policies are being drafted or why these policies are being approved, because I was not at the approving side, I was just at the implementation side. So when I studied, it was really good, and different organizations in the world have praised Pakistan.
All right, maybe you can share the future suggestion, because some of our students, our audience are in the 5th semester, and in this 6th semester in Indonesia, we have to prepare the undergraduate thesis. Maybe you can share the future suggestion. Maybe some of our students are interested to study about the financial management like you.
Of course, you can discuss with me if they have anything in mind, but what you can do is maybe prepare a dissertation on the tax impacts, prepare a dissertation of sustainable finance, Islamic banking finance, and things like that. But if you have anything in mind, or if you want to have any particular question, then you can of course discuss it with me.
All right. Okay, guys, is there any question from you? Okay, I have a question from Putri, Mr. Jazib. Sorry, sir, I want to ask on slide 2. What are the company benefit with angel investors?
Angel investor, the thing is, you get quick money, easy money. Angel investor is people like just me and you, Hafiz Sofiani, and who have a lot of money, and they just think that, okay, this project looks good to me, so I will invest in that money. Angel investor will be able to give you the quick money that you need, and they will be able to share their experience with you, but they will not come into your office, sit on your management board, and overview your project. Yes, there will be decisions, there will be instances that when they come and discuss about your project, because of course they have the money, they have funded you. But apart from venture capital, and the main difference between venture capital and angel investor is that venture capital has one person, the employee, the board member sitting in your company, to overall understand the management procedure and run the management procedure. They have a big say. Angel investor just give you the money, and sometimes they come and discuss with you about the project, but they are big individual rich guys.
Oh, all right. And I think they are scarce, yeah.
Like we study in economics, everything is scarce.
Yeah. Okay, thank you very much, Mr. Jazib, for your answer. All right. Actually, we also see in the reality now, we see any crowded funding and online lending. What do you think about that, Mr. Jazib? This is because this has become phenomena in Indonesia, but sometimes, of course, it's give some benefits for the SMEs, especially because to get a lending from the banking, sometimes SMEs cannot fulfill the requirement, so they try to look for any alternative for the funding. But when they do online lending, even though the rate is quite small, but sometimes it's not really favorable. They are trapped in the lending now, many SMEs in Indonesia. What do you think about that?
It's a bit complicated. Yes, these policies, these financial plans come, and sometime you get quick money, but ultimately, I'm not sure if you have heard of Ponzi schemes. There can be instances where because these funding projects that you have crowdfunding or other things that you've mentioned, if they have a solid business plan of making them a return, of solid business plan of cash flows, then of course it's fine. that as long as the business is sustainable, they may be able to support you. But if they do not have any sustainable plan, like a Ponzi scheme, they are not generating any money. If I go into the business and then after me you invest, so they will be able to give the money to the third person or to you or me. But after a time, when they are unable to find any new members or new investors, then the person who invested the money at the last, because now they are not getting, the company is not getting any more investors, so the money from the last investor is gone. It's like it's a loss. So it depends. As long as you are investing in a company which has good, sustainable, solid business plan, then it's fine. But try and understand the business plan first of any company, how they are going to support you in terms of business. Crowdfunding, you said. Crowdfunding is a different plan. Like, you generate money from different people around the world, you create a cause, and then you advertise it, market it, and then there are people who are kind, generous, they just look for those causes and they support you. So as long as it's fine, but it does not have a solid business plan. Like, it does not have a and what should I say, that a fixed reason of investing. If, like, you create a crowdfunding cause and I don't feel like supporting that cause, you cannot ask me to invest in it. But if I am generous and I feel compassionate and I understand the cause and I feel that yes, it's good for humanity and I can spare a few dollars, then yes, I would love to invest. But it depends. It does not have a guarantee of investment returns.
All right, thank you very much, Mr. Jazib. Okay, is there any question again? Okay, if no, maybe I would like to conclude our meeting today. So in the capital investment, is there any certain formulas that you need to comprehend to analyze whether the investment is favorable or not? So don't do a decision without any calculation, because you will getting lost after that. So thank you very much, Mr. Jazib, for your willingness to be our speaker today. Hopefully we can collaborate in the future again in the next agenda.
I have if you don't mind, I have a question. I was given that the timetable and everything, the overall schedule of sessions, and it from that I can understand that there were 2 sessions for capital investment, lecture 9 and 10.
Oh, maybe the administration will inform you further.
Yeah, because I said that I was interested in capital investment decision. So if there is any further collaboration, even not in capital investment decision, maybe anything else, please do let me know. I would be happy to share my knowledge.
All right. Thank you very much, Mr. Jazib, for your kindness. All right. Thank you very much for your attention. I take it back to the master ceremony. Please, Nadia. Nabila, sorry.
Okay, thanks to Mr. Jazib Ali, MSc, for the attractive material. Hopefully, it can help the audience to have a better understanding of managerial accounting. And thanks to Mr. Hafiz Sofiani, SE, MSc, as a moderator, who guide the discussion today more thoroughly. Now, we are turning to the last agenda, which is closing. As the master of ceremony, I do apologize for any mistakes during this event. Finally, I say thank you. Before leaving this event, kindly please everyone turning on your camera because we want to take a picture. Okay, ready? 1, 2, 3. Once more. 1, 2, 3. And once again. 1, 2, 3. Thank you for joining this event and see you on the next event. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. See you next time, Mr. Jazib in Yogyakarta.
Thank you very much for hosting me, and inshallah, definitely, I would love to visit Indonesia. Final thing that I would like to say is, aku cinta Indonesia.
Terima kasih. Terima kasih. Assalamualaikum.
Take care, guys, and hope to see you soon.
Assalamualaikum.
Waalaikumsalam.